Welcome to Innovating with Scott Amyx. I'm your host, Scott, and today I'm joined by Andy Lerner, who is the managing partner of IA Capital Group. Welcome, Andy.
Hey, I'm happy to be here.
All right, so tell us about IA Capital.
Sure. We're a New York-based venture capital firm. We've been around 25 years investing in venture capital. For the last 20 years, we specialize in fintech and a subset of fintech that we've been particularly active in say, for the last 5 years, but longer, before it was called insurtech. We've always cared a lot about insurance technology. We're focused on North American opportunities, so we principally invest in the US and Canada. We look for Series A, B, C companies. So we typically do not get involved in companies pre-revenue. We like companies that have about $1 million or more of revenue. And we'll take a look at, within our geographic and size parameters, we'll take a look at just about anything, certainly in insurtech and also in the broader fintech space. And in addition to venture capital, from time to time, if we see a great opportunity and there are no entrepreneurs focusing on it, we'll start our own company. So we'll recruit a management team and put together a company and form it ourselves. So from time to time, we do that as well, in addition to our venture capital activities.
Yeah, that's really fascinating. So you got a bit of a hybrid approach, but let me go back to your investment philosophy, thesis, and methodology. First, on the geography. Now, when it comes to insurance tech and, of course, just general fintech more broadly, there are a lot of innovation that's happening outside of North America. So, whether it's London, whether it's Singapore, and other parts of the world, why just North America? And are you potentially losing out on some great opportunities as a result of that?
It's a great question. I think that we're more industry experts than technology experts, if that makes sense. And there's great technology around the world, but financial services and insurance is highly regulated. And we try to be experts within those regulatory environments. So insurance, for example, is regulated by each of the 50 states differently. And we think we have a very good handle to give advice to our portfolio companies on the regulatory aspects. It's a very large world, and we don't pretend to be experts on regulatory environments around the rest of the world. So we feel like we can add the most value within North America. But there are fantastic opportunities around the world. It's just we're a small firm, and we focus on what we know best.
Yeah, I really liked your emphasis on the fact that you guys are domain experts within the industry, and the industry and the complexity behind that. And certainly for the viewers and the listeners, is that when we talk about insurance, it's actually a pretty broad category in itself. Even that's fairly broad. You have life insurance, you have disability insurance, you have property and casualty insurance, you have professional errors and omission, and it just goes on and on. And each of those verticals have their own set of unique sets of domain subject matter expertise, and of course the regulatory bodies that oversees those as well. Can you walk us through just a little bit, kind of that layer below, around how complex it is, and also the changing legislative and regulatory environment that we're living in?
Sure. And you're right, we do pride ourselves on being experts in the sector. And I should mention that the large majority of our limited partner investors are insurance companies. So we have 13 insurance companies that invest with us, and we're very proud of that fact. So if we were a biotech venture capital firm and we had 13 pharmaceutical companies invest with us, you would say, hey, they know what they're doing in that space. So we feel like it's a great endorsement that all these insurance companies that know their business better than anyone invest with us. So you're absolutely right. There may be three major areas of insurance. One is property casualty insurance, and that's business insurance, auto insurance, homeowners insurance, and a lot of other, pet insurance, a lot of other types of lines of business, but that protect property, or they protect, casualty or liability risks. Then there's life insurance, and under the life insurance umbrella, you have a lot of retirement products, annuities, and then you have health insurance, which everybody knows health insurance. So you're right, there are different regulatory regimes. You can have a life insurance license, but not a property casualty insurance license, for example. So we have all those companies as investors. We look to invest across all those sectors, and it gives us some diversity. So, for example, in our portfolio, if there's a major event like an earthquake, that might affect one company that's writing home insurance, but it's not going to affect the rest of our portfolio, which could be a company that looks to sell life insurance or annuities or some other products that would be much less affected by a disaster. So investing in all areas of insurance really gives us diversification, and each one has their own specific aspects. Although I should say this coronavirus epidemic is starting to affect every business in America.
Yeah, absolutely. So I want to actually go back, let's say 10, 15 years. So if you were to give a kind of a sweeping broad stroke around the kinds of changes that you've seen, especially in insurance tech over the last 10, 15 years, how has that changed? And then moving forward, what are the kinds of changes that you're expecting to see?
Right.
Specifically, I'm asking for things that really kind of either surprised you or delighted you.
Well, I first got into fintech 20 plus years ago because it just made so much sense for people to use payment methods other than cash or check. Those were old-fashioned even 20 years ago, and electronic payments, whether it's credit card, debit card, ACH, just made so much more sense for the economy. And I think that's been a big theme in fintech. Face-to-face payments or paper payments less, and electronic payments more. So insurtech has become interesting to us for the last 6-7 years because it's maybe early on. It's maybe where fintech was 15 years ago. Still, a lot of insurance is done with paper forms. A lot of insurance is being sold face-to-face through your local agent, and less is being done through electronic means. So insurtech, we identified it as an area ripe for disruption. It makes more sense for people to shop online for insurance rather than needing their agent at the country club. Like a generation ago, you would buy insurance from the person that belonged to your local club. Today, people more and more want to shop through electronic means, and it's just much more efficient. And that's just a long-term secular trend. So we're not trying to time the market. We're not trying to time interest rates or whether insurance prices are hard or soft. We're trying to take advantage of long-term trends of people using electronic means to purchase insurance, underwrite insurance, assess claims. Big themes like AI and big data are helping the industry assess risk better. So we're trying to capitalize on all those major long-term themes.
Yeah, I really like the point about the data aspect is that aside from the automation of the workflow, so much of the kind of the emerging sets of technologies within your category is around the fact that there's not just better data, but more regular, frequent, almost real-time data, which is important because when you're assessing either underwriting or assessing the continuing risk profile of a particular household or business, you need real-time data to be able to ascertain where it is today, as well as predict the forward future aspect, whether it's actuarial or potential risk aspects such as property and casualty, like flood and hurricanes and so forth. So data becomes super important. What are you seeing in terms of use of data for optimization and use of data for predictive analytics and ultimately to reduce that risk premium, and then in the process also have a, let's say, a risk mitigated pool in that framework.
Right. There's so much data out there that insurance companies could and should capitalize on the data. Sometimes the privacy issues become what's standing in the way. But your cell phone, for example, gives you so much information potentially on your driving habits. Are you texting while driving? Are you braking sharply? So just data on your cell phone alone can help a company better underwrite a driver and assess the risks. And there's a lot of telematics, and there's also a lot of technology built into vehicles today in modern vehicles, and Tesla's a leader in telematics and starting to get into the insurance business themselves. So that's just one example. But then there's IoT in homes can better assess risks like flood, for example, and then life insurance as well. Old-fashioned life insurance's underwriting is through getting a blood sample, and today you can tap into medical records with a person's consent, for example, and just get a better idea of risks. So the data is out there. The companies are starting to harness it, and then the biggest issue becomes privacy. What are individuals willing to share with their insurers, and what data are they not willing to share?
Now, is it possible that there's a bit of data anonymization so that the startups are not looking to get specific individual data per se, but general data that can be classified on a kind of a cluster base or similar profile types,
right,
to provide some level of assessments?
That's right. That's the AI. People are fine-tuning their AI based on anonymized data, and you're getting billions of driving miles going into AI that assesses safe driving habits. That's not identifiable to any one person. But then when you're pricing an insurance policy, you need to take into account those person's specific characteristics. So a lot of insurance today, auto or home insurance, for example, the companies will do a credit check, and that's your personal credit information, but it is your personal information that companies take into account. So it's really for pricing and assessing the risk of the individual. It's where the privacy comes in. But your point is very good that the industry can get smarter overall by using the anonymized data.
Yeah. So just to get a little bit more concrete and specific, can you give us an example either from a portfolio startup or a startup that's out there that you're very excited about, and why?
Yeah, I mean, we have a bunch in our portfolio, and you can go to iacapgroup.com and check out all our investments. One company that's doing a great job is a leader in auto insurance claims called Snapsheet, and we're one of several venture capital investors in there. But auto physical damage is, there are millions of accidents each year. It's a huge area, and sometimes people have a total wreck of their car, but sometimes they might only have $500 worth of damage, and that needs to be assessed. And Snapsheet has the technology where you could take pictures with your Snapsheet app, and you don't have to have somebody come to the actual crash site or after the crash to look at your car. So it's very efficient. It saves time and effort for assessors to come and look at the car, and Snapsheet has all the technology to take those images and assess the damage and adjudicate the claim on behalf of the insurance company very quickly. So it fits into our overall theme of less human interactions and more using technology to make insurance more efficient. And it's nice to be invested in a company that's the clear leader in the space. So I think the majority of the top 10 insurance companies use Snapsheet.
Terrific. Sounds great. Can you give us a bit of a forward prediction around what's expected to come around within the insurance technology space?
Yeah, a few things. One is, I think the biggest tech companies are going to get increasingly involved in insurtech, whether it's Amazon or Facebook or Google. I think you go out a few years and they won't be insurance companies, but they'll be somehow selling insurance through their customer base. These are companies that have majority of Americans as customers already. It's easier for them to distribute financial products through digital channels, and they're going to need partners that are actually licensed insurance companies. They're going to need partners that can handle claims, and we've set up some companies with the idea that one day these big tech companies are going to get involved in insurance, but they're also going to get involved in other areas. You're seeing that today, where payments is becoming an increasingly important focus for companies like Amazon and others. But insurance in particular, we expect them to come in the next 5 years. Another prediction is today you have a bunch of scrappy startups that are mostly earlier stage in insurtech, and then you have these 100-year-old huge insurance companies that are very slow in changing their ways. And I think what's going to happen over the next 5 years is there's going to be a convergence. As the leading insurtech companies grow, they're going to start getting insurance licenses, they're going to start building regulatory and compliance, and they're going to be a little slower and less nimble than they are today just because they have to adhere to the regulatory schemes. On the other hand, the largest insurance companies are starting to invest heavily in technology, and they can't change their systems overnight or even in 1 year, but you go out 5, 10 years and they can start having a much better customer experience. They can sell more products through digital channels as opposed to traditional agents. And I think that 5, 7 years from now, there'll be a blurring of what's an insurtech and what's an insurance company, whereas today there's a very, very clear distinction.
And I wonder if that landscape change that you're talking about, to some extent, is already happening in the broader fintech, whether it's on the banking side or traditional capital markets. And it's for the larger company, it's not just kind of internally homegrown, but also investing in small minority equity positions into startup ecosystem, much like what Intel does. But also leveraging, venture studios and other outside innovation labs for some of those things as well.
Yeah, that's a great point. And I think that in banking, there's been a clear delineation because the banking regulators have not traditionally let fintechs get a banking license. So these very innovative companies like PayPal is huge, but it doesn't have a banking license. And people really think of PayPal as a fintech, whereas JP Morgan Chase has very good technology, but it's a bank and people know it's a bank. It's already blurring in insurance because the state insurance regulators have been much more forward-thinking and been more friendly to innovation than the banking regulators, and they're allowing the insurtechs to get licenses. So they're big. We're investors in this insurance company, ClearCover. It's starting out auto insurance and has aspirations to write other lines of insurance. And it's clearly an insurtech company, but it also has a license. And so that blurring is already happening today, whereas the regulators just now starting in 2020, I saw that banking regulators are just starting to let fintechs have licenses, starting with Square and Varo. But those are really the first two almost ever of tech companies that are getting banking licenses.
Yeah, we only have about a minute left. I wish we had more time.
Sure.
So let's kind of pivot and talk about advice for entrepreneurs that are trying to disrupt a legacy industry like insurance. So based on your portfolio startups as well as just your general broad 25 years of experience, what have you seen that are just really pivotal regardless of the specific nature of that startup that entrepreneurs need to take into consideration?
Well, hopefully entrepreneurs look past the coronavirus and don't, so many companies are just frozen today or reacting to the crisis. And so an entrepreneur needs to think forward about the whole career, because today it's almost hard to get anything new done. But I think that there are a lot of entrepreneurs that have a bad insurance experience and then want to go disrupt the sector. So they had a bad experience buying pet insurance, for example, and they want to do a better pet insurance company. But those areas are getting a little crowded. I would encourage entrepreneurs to look for areas where there are not already 50 startups focused on. So products for older Americans, for example, are greatly underserved by digital channels. So whether that's Medicare Advantage or selling annuities or selling retirement products, those I think are ripe for disruption, and there are relatively few entrepreneurs focused on it. So you really have to take a look at, there are a lot of smart people out there, a lot of well-funded entrepreneurs, and you want to pick and choose a place where there's not a lot of competition. But in general, we are so happy with the quality of entrepreneurs coming into insurtech. It's something I never dreamed when I first started in the industry.
Well, that's great advice, and certainly when it comes to annuity and retirement, those are some massive, massive trillion-dollar markets. So certainly that's
Exactly.
beckons for startups to come in. So today I've been joined by Andy Lerner, who is a managing partner of IA Capital Group. Thanks for joining today.
Thank you.